Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In the last episode, I talked about two broad ways of making decisions in the market, discretionary and systematic. We concluded that if you are new to trading, it's wiser to begin with systematic approaches and then gradually add layers of discretion as you gain experience. Today, I want to take that conversation a step further because no matter which path you choose, discretionary or systematic, you'll still need to rely on data or information. By data or information, I mean the inputs that would help you form a view on a stock, an index, or a commodity. Like I always do, let's set the stage with a key question. What does it mean when I say forming a view about a stock, an index, or a commodity? I think for a view to be valid, it should answer these three questions, else it's just mumbo jumbo. Question 1. Will it go up, go down, or stay in a range? That's directional bias. Question 2. If it moves, how far up or down could it go? And if it stays in a range, what's the band? That's directional extent. Question 3. By when will it reach the high or low? Or how long is it likely to stay in a range? That's time component. Now, to answer these questions, you can draw on three broad types of inputs: fundamental, technical, and alternative. Each brings its own lens to help us refine our view. If you recall, I used Google Maps as an analogy to explain systematic rules-based trading or investing. Let's extend that analogy to three types of data. Technical data is like a basic route guide. It would include the path, turns, and estimated time to reach your destination. Fundamental data is about the underlying terrain and conditions. If there was a way to incorporate data about the quality of roads, the weather forecast, the presence of tolls or steep climbs, that's what it would be. Alternative data, on the other hand, adds real-time signals, stuff like unexpected roadblocks due to an accident, or even live updates like footfalls at a restaurant you might want to stop at along the way. When you combine all three streams of data, you are more likely to find the most optimal route to your destination. It doesn't mean you always need each of these data sources, but these are like tools available to you, and depending on the situation, some may be more reliable than others. Now let's dive into what each of these are and how they can be used in the context of trading. From a historical perspective, technical analysis came first. In the early 1900s, Charles Dow developed what we now call the Dow theory. Many of the core ideas in technical analysis trace back to this framework either directly or indirectly. They include ideas like prices have a trend, prices discount all available information, and the idea that markets respect levels of support and resistance. The DJIA, Dow Jones Industrial Average, one of the world's most widely followed indices, is itself a direct offspring of Dow's thinking. Charles Dow's influence on modern-day technical analysis cannot be overstated. By focusing on the importance of price movement, he gave rise to an entirely new way of understanding the markets. And through his editorials in the Wall Street Journal, these once niche ideas became mainstream. Today, technical analysis goes far beyond simple price charts, patterns, and trading volumes. Modern interpretation include a wide range of tools and concepts, from momentum indicators to volatility measures, market breadth indicators, and quantitative models that can scan vast amounts of historical data. In short, technical analysis has evolved from a purely chart-based discipline into a broader framework that blends data and quantitative methods to understand and anticipate market moves. It was only later, in about 1930s, that fundamental analysis emerged as a structured discipline. With the publication of the book Security Analysis in 1934, Benjamin Graham and David Dodd, known commonly as Graham and Dodd, documented a systematic way to assess the intrinsic value of a security. Focusing on earnings, assets, and financial stability of a company, they were the ones who came up with the idea of margin of safety. Graham is often called the father of value investing. He reframed markets as places where one could separate investing from speculation by grounding decisions in business reality rather than price patterns. At that time, Graham and Dodd were a bit critical of analyzing securities just based on price, and perhaps Graham's famous quote alludes to that when he says, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. But frankly, to us as traders or active investors, it doesn't matter if the market is a voting machine or a weighing machine, so long as we are able to make money from it. Talking about the use of fundamental data today, thanks to easy access and widespread use of AI, analyzing fundamentals has never been faster and more scalable or more democratized. What once required teams of analysts poring over annual reports can now be done in seconds all by yourself. All that you need is a bit of curiosity. For basic fundamental analysis, I personally use Tijori Finance for all my needs and also for some quantitative measures like rate of change, etc. Moving to alternative data, as digitization and big data took hold around the early 2000s, active investors began drawing insights from non-traditional sources like satellite imagery, the retail parking lots, credit card transaction flows, app downloads, shipping records, web traffic, and even social media sentiment. This new stream of inputs went beyond what the companies report, that is fundamentals, and how prices move, that is technicals. It has the potential to capture signals from sources that could reveal hidden trends and opportunities. While alternative data has gained significant traction in the US, in India, access to reliable sources is still limited, which is why its use in trading and investing remains relatively uncommon. Taken together, these three streams, technical, fundamental, and alternative, show the evolution of how markets can be studied and how you can form a view about a given stock, index, or commodity. By now, you're probably thinking, enough theory, Sandeep, give me an example of how to actually use these approaches in trading. Alright, let's walk through it. Suppose you've been following our weekly market metrics segment in the long and the short show. Let's say you notice auto sector showing up among the top performers for several weeks in a row. That in itself is a technical or a quantitative signal, as we are scanning sectors looking for momentum using the rate of change as a metric. That's step one. Let's call it sector scan. The idea is to start broad, use a quantitative or technical screen, rate of change, all-time high breakouts, relative strength, etc. to identify which sectors are trending. Once we have identified a sector, step two is stock selection. Drill down within the sector and pick the top 3 or 5 stocks showing the strongest momentum. Again, using measures like rate of change or recent breakouts. Step 3 is where we use a fundamental filter. We put the 3 or 5 names through a basic fundamental check. You don't have to incorporate each of these, but these are some key fundamental filters that you can use. Quarter-on-quarter EPS growth, return on equity, debt-to-equity ratio, interest coverage ratio, and valuation multiples like PE or PB ratios. From your 5 stocks, you might narrow it down to 3 stocks that pass through these fundamental filters. Over to step 4, which is about adding a layer of alternative data. Here we look for non-traditional signals like social media chatter about the companies or their brands, online reviews, search trends, or app downloads. This helps us gauge sentiment and the consumer traction that won't yet show up in the quarterly numbers. One last step, the step 5. Here we go back to the technicals. We would revisit the charts for the shortlisted stocks, check whether they are breaking out of a range, closing above key moving averages, or approaching a key resistance level. For instance, if you notice a stock which is trading below 200 DMA, in which case you might choose to skip it for now. The steps we discussed aren't just useful for stock selection, they can also guide decisions on whether to hold or exit a position. You may be able to use technical concepts like relative strength or standard deviation to determine how long you would like to hold a security. I don't know about you, but it has indeed happened with me. When I buy a stock, the whole sector tends to perform except for the stock that I hold. This is when having rules around how long you would like to hold a stock if it's stuck in a range really helps. Likewise, you might return to technical signals such as a defined drawdown percentage or to fundamentals like a sharp change in key ratios, and in some cases even adverse news about management or governance can serve as a trigger to exit a stock. Using technical, fundamental, and alternative streams help us broadly answer the 3 questions we had raised at the beginning about directional bias, directional extent, and the time component. And just to be clear, the point here isn't to recommend a specific approach, ratio, or method. The idea is to show how technical, fundamental, and alternative data can be layered together to form a complete view about a stock, an index, or commodity. Here's a summary of what I have been trying to say. Technical analysis and quantitative metrics are more about when to trade, while fundamental analysis and alternative data inputs are more about what to buy and sell. If there is one book that I would recommend for this space, it is How to Make Money in Stocks by William O'Neill. In the book, he details a stock selection method called CanSlim, one of the best known approaches that blends fundamentals with technicals for stock selection. Do note, it doesn't talk about alternate data. Lastly, smart traders and active investors don't rely on just one approach. They build their own blend, assigning different weightages to fundamental, technical, and alternative data, depending on their style and goals. There's no holy grail here. Each stream has its own strengths and its blind spots. What really matters is developing expertise in one area and learning how to apply that knowledge effectively while being aware of other approaches as well. That's the process through which we evolve as traders and active investors. So that brings us to the end of part 1 of the episode. With that, let's move to part 2, something more practical, that's our weekly market metrics. Let's take a quick look at how the markets played out this week. On Monday, Nifty opened with a positive gap of 61 points and then followed through on the upside for the whole week. Between last Friday and this Friday, the index moved up 373 points, that is 1.51%, and Nifty is finally above the 25,000 level, which was a resistance until last week. This is a big round number, and it was also a psychologically significant resistance. Hopefully, Nifty sustains about 25k in the coming weeks. Talking about gaps, Nifty had positive gaps on 4 out of 5 days this week. If we zoom out a bit, all indexes including Nifty have had 2 back-to-back positive closes on a weekly time frame. Coming to Nifty Bank, as I had pointed out last week, 53,500 worked as a support for Nifty Bank and the index is up 1.28% this week. Though Bank Nifty is still negative for the month and the weakest among other indexes. Talking about rate of change, this week all indexes are in green. On a year-to-date basis too, we are in green across all indexes. Mid-Cap Select was the highest gainer this week with 2.39%, followed by Nifty at 1.51% and Nifty Bank at 1.28%. We are 9 months into the calendar year 2025 and Nifty is showing a positive of 6.21% gains, while Mid-Cap Select is merely up by 1.36%, the weakest of the lot on a yearly time frame. Just last week I had spoken about Nifty being stuck in a tight range of 5.4% on a weekly chart. We still continue to be in that range and this would be the 13th week in that sense. Talking about sector-wise markets for the week, if you look at the table, the trend this week is way different from last week. IT and PSU banks are leading, followed by PSE, CPSE and metals. Nifty IT is the new entrant this week along with PSU Bank and CPSE. Nifty PSE and metals continue to be in the top 5 sectors since last week. Speaking of commodities in general, gold and silver again hit an all-time high, copper is in an uptrend and both natural gas and crude oil are showing some weakness. Moving to overnight versus intraday structure on the indexes, this was one of those weeks where the gains came largely from gaps, that is overnight, and a bit came from intraday as well. Overnight we are up about 1.02% and intraday we are up about 0.23%. Moving to options, the Nifty weekly expiry on Tuesday had a super narrow range of just 78 points, which is only 0.31%. Option sellers obviously had a smooth day. The Sensex expiry on Thursday had a 425 point range and again was a relatively smooth day for option sellers. If you were an option buyer, there wasn't much to be made in either of the expiries. In other news this week, NASA rover seems to have found signs of life on Mars, but closer home, planet Vix seems to have gone dead, no signs of life in it whatsoever. Anyways, in theory, such ultra-low VIX means that there is a decreased hedging demand and the options market is not pricing in much of an event risk. Low VIX quite evidently shows up in the low intraday ranges as well. Just compare the 5-day average daily range with the 10-day average daily range and you will see the effect. Same with weekly range and the 10-week average range. The decision to scrap the weekly expiry ignited a storm on social media, with opposing camps hurling shots at each other. No confirmed news as yet. I am recording this on Friday, but SEBI's meeting is still ongoing. More than anything, it's the uncertainty which is disconcerting. Talking about the directional bias so far, all indexes are above the 21-day EMA. However, Nifty Bank continues to be below the 50-period EMA, indicating weakness. Rest of the indexes are positive both on short-term and medium-term timeframes. Moving to our outlook for the coming week, news and event-wise, hopefully there is some trade deal that happens between the US and India. Looking at the positive commentary and the tweets by DJT, looks good so far, but with him you never know what's in store next. Directionally again, it looks like in the coming week, Nifty may continue its up move with an average weekly range of around 387 points. We may hopefully close around 25,500 by the end of next week. The short time frame trend following strategies that I track on Nifty and Bank Nifty were short last Friday, and as I had expected, the shorts didn't last. So the Nifty went long on Monday and Bank Nifty went long on Wednesday, and both continue to be long as of Friday. Beyond this, there are no scheduled events in the coming week and no market holidays either. So that's pretty much for the long and the short this week. Thank you for watching, and yes, please do like, comment and subscribe to this channel. Thank you.